Welcome to today's Explainer. We're diving straight into a massive question that's literally on everyone's mind right now. ¿Por qué suben las tasas al 12%? Why exactly are interest rates in Colombia shooting up to a staggering 12%? Our goal today is to unpack the macroeconomic forces driving the central bank's decisions and reveal how this complex situation directly impacts your wallet. Whether you're looking to buy a house, manage your credit cards, or invest your savings, these rate hikes change the game entirely. So, let's dive right in and make sense of the numbers.
Here's our game plan for today. First, we'll look at the rate soap opera. Second, why raise to 12%. Third, pocketbook impact. Fourth, global unemployment factors. And finally, future outlook.
All right, kicking things off with Section 1, the rate soap opera. There is definitely some friction at the bank.
You know, whenever monetary policy bumps up against political goals, sparks are going to fly. And we've seen that play out in real time this year. We started with two quick jumps, 100 basis points each, taking us from 9.25% to 10.25%, and then up to 11.25%. Now, 11.25% is where the drama really hit the fan. Finance Minister Herman Avila famously stood up, argued the bank was acting against the people, and actually walked out of the meeting in protest. After a brief pause to kind of calm the waters, the board ultimately made the tough call on June 30th to hike it again, hitting that 12% mark.
And that decision, it was far from unanimous. In fact, the June 30th vote perfectly highlights how fractured opinions are right now, even among the absolute top experts making these calls. The board was totally split. 4 members voted in favor of the 75 basis point hike to 12%, 2 actually wanted to lower the rate by 50 basis points, and 1 member just wanted to hold it steady. Those 4 votes won out, obviously, but that 4 to 2 to 1 split tells you that steering this economy is a seriously delicate balancing act with vastly different viewpoints on the best path forward. Moving on to Section 2, why raise to 11%? Let's look at the hard economic data.
So despite all that heavy political pushback, the central bank forced this hike through anyway. Why? Well, we just have to look squarely at the data from Dane. Inflation has been on a relentless month-over-month climb. At the close of last year, in December, it sat at 5.1%. Aside from a tiny dip in February, it's just been marching upward, hitting 5.56% in March and 5.84% by May. Analysts are even projecting it could close out between 6.4% and 7%. When everyday things cost more every single month, it creates a compounding crisis for families. That rising trend is the exact justification the bank used for the 12% hike.
Here's the absolutely crucial point, though. A lot of the rhetoric out there suggests the bank is just acting against the consumer. But objectively speaking, they are bound by a strict constitutional mandate. By law, the Banco de la República's primary job is to maintain controlled inflation right between 2% and 3%. So when inflation is hovering near 6% and trending towards 7%, which is basically 3 times their legal limit, they are legally obligated to step in. If inflation spirals out of control to 8% or 9%, it acts as a devastating hidden tax on literally everyone's savings. The rate hike is simply their mandated tool to hit the brakes.
Okay, Section 3, the impact on your pocket. Let's talk about how this actually hits your finances.
Stepping away from the macro level for a second, let's look at this 4-step mechanism to see how a 12% rate alters your daily budget. Step 1, the central bank raises its rate. That's the rate it charges other banks. Step 2, your local banks pass that cost right on to you, making consumer credit, credit cards, and mortgages much more expensive. Step 3, because borrowing costs an arm and a leg, everyday folks and businesses stop spending so much, meaning overall consumption drops. And finally, Step 4, with less demand for goods and services out there, prices stop climbing and inflation cools off. It's a bitter pill to swallow for sure, but making money more expensive is the traditional proven cure for the disease of rising prices. So a 12% rate is really a massive double-edged sword. On the negative side, if you've got a variable rate mortgage or you rely heavily on consumer credit, you're going to feel the pinch. That means less cash flow for you every month. But there is a brilliant silver lining here for savers and investors. Because banks desperately need to attract capital to lend out at these higher rates, they're offering incredible returns on fixed income products. Right now, certificates of deposit, or CDTs, are yielding anywhere from 13% to 14%. Think about that. If inflation is around 6% and your CDT pays 13.5%, you are actively beating inflation and genuinely growing your wealth.
Let's move to Section 4, Global and Employment Factors. Let's examine the external pressures.
To figure out why inflation is being so stubborn, we have to look outside of local consumption. International pressures are playing a huge role here. Take the ongoing conflict in the Middle East, for example. That's creating immense volatility and keeping global oil prices super high. And when oil is expensive, energy is expensive. When energy is expensive, global logistics, shipping, and travel costs just skyrocket. Ultimately, expensive transport means the food and goods arriving in Colombia cost way more. The central bank obviously can't control a conflict halfway across the world, but they are forced to use high interest rates to defend the local economy against the inflation it brings.
Now, domestically, we've got a really interesting paradox going on with employment. Unemployment actually dropped to an impressive 8% in May. On paper, hey, that is fantastic news. But there's a catch. The data notes that since January, over 100,000 new jobs were created specifically in the public sector, mostly the executive and judicial branches. Now, jobs are great, but funding 100,000 new government salaries increases the state's deficit if it's not matched by new revenue or higher productivity. Pumping all that government money into the economy puts massive inflationary pressure on the whole system. And that, again, forces the central bank's hand to raise rates to cool things down.
Which brings us to Section 5. What will happen in the future? Let's check out the outlook.
With the next highly anticipated central bank meeting set for July 31st, market experts are totally divided on whether we've hit the ceiling or if there's more pain on the way. Just look at these analyst projections. BBVA predicts another 25 basis point hike to 12.25%. Bancolombia is projecting a massive 75 basis point jump all the way up to 12.75%. But then, Davivienda believes we finally hit the peak and expects the bank to hold steady at 12%. Because inflation is pushed around by so many wildcards, from weather patterns like El Niño to global conflicts, nobody has a crystal ball here. But it's very clear the market is bracing for a variety of outcomes.
Despite all that uncertainty, there is one absolute key takeaway you need to focus on right now. As noted in the data, we likely have a 3 to 6 month window of peak rates for fixed income products before they start to fall. Listen, if you're an investor, this is your golden window. As the economy eventually cools down and consumer spending drops, the central bank is going to have to lower these rates. That means those incredible 13 to 14% yields on CDSTs, yeah, they won't last forever. Locking in those high fixed income rates right now for the next 6 to 18 months could be a brilliant strategic move before the economic adjustments force yields back down.
And that wraps up today's Explainer. But before we go, I want to leave you with this final provocative thought. Based on the political soap opera, the inflation data, and those totally divided forecasts, what do you predict will actually happen on July 31st? And maybe more importantly, how are you actively adapting their personal investments to take advantage of this unique 6-month window? The macroeconomic forces are shifting fast, and just standing still, that's really no longer an option.